Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back at the end of another week for a weekly market recap with my good friend, portfolio manager, Lance Roberts. Hey, buddy. How you doing, Lance?
Well, it's Friday, and good. Glad this one's over, too. I think I said that last week.
I think you've said it the past bunch of weeks. You've had a real survival theme.
I know. I tell you, it's been a weird couple of weeks. So there we go.
Okay. Well, speaking of weirdness, I think that kind of is a good word to describe the market action this week. Things got real weak, and then today they bounced pretty hard. All right, what I want to dig into you is the rebound we're seeing here. What are the chances that it's for real, that this is bouncing off the support of the lower end of that battle zone for control we've been talking about? Real quick before we unleash on that, I just want to remind folks about the Wealthion online conference that's coming up on Saturday, March 18th. That's not too far away at this point. And reason why I'm mentioning it here at the beginning of the video is because the early bird price for that conference expires at midnight this Sunday. So I want to make sure that folks know if they've been procrastinating, meaning to register, but haven't done so yet, they should do so right after watching this, maybe even while they're watching this, just so they can lock in that early bird discount. To do that, folks, just go to wealthion.com/conference. If you go to that page, you'll get all the details on the conference and you can sign up and register at that early bird price. I will, at the end of this video, opine a little bit more about what to expect at the conference, but I just wanted to make sure that that was burning brightly on folks' radars. All right, Lance, so back to the rebound. What do you think? Is this thing for real, or we got to wait and see?
Well, no, it's always wait and see, right? Because we can't predict the future. So, is it for real or not? Who knows? But, we've been talking about the fact that, look, markets were very overbought. Beginning of February, we said, hey, we got a sell signal, reduce some equity risk there. We're going to get a correction back to support. So here we are, and we nailed the 200-day moving average, and buyers showed up. So, the beginning of this week, action was weak, and we just kind of kept dripping down towards that 200-day moving average. And yesterday we touched right on it, bounced off of it yesterday into the close, and then a nice. And Friday was actually a very bullish day action wise, very broad advance across the board, steady buying all day long. It wasn't like a big spurt of buying. It was just we opened up early in the morning and just kept building on that all day long. That's a very bullish sign. It shows buyers are coming back into the market. So, for all intents and purposes, yeah, this looks like a sustainable rebound, and the 20-day moving average, which is around 4150, something like that, is the first target. And the top of this trend we've been building from the October lows is right around 4350. So there's a reasonable upside here to trade over the course of the next month. And we're still in the seasonally strong period of the year. So there's a lot of, historical seasonal tendencies behind the market right now. So, and it's also the end of the quarter. So after having a very strong beginning of the year, there's a lot of portfolio managers that were lagging that advance. They were waiting for a pullback as well. So now, we could see a lot of positioning being put on between now and the end of the month for quarter end window dressing. So there's some reasons this rally could have some legs to it.
Okay, and we have been talking about that if this thing bounces off of support, like it looks like it's maybe in the process of doing right here at the end of the week, that it could run up to 4,300, 4,400, like you said. And it seems like from what you're saying that this is a technically clean response that we're seeing here, right? Got right down to that lower bottom level, and then it's kind of off to the races once it hit that bottom nadir. You're nodding as I'm saying all this. So yeah, we've been saying, hey, this battle zone for control, at some point the bulls or the bears are going to win it. Probably too early to declare victory, like you said, but from everything we're seeing right now, it looks like things are playing to the short-term bull playbook, funnily enough, as of really today. Yesterday, we might not have been having this conversation.
Well, no, even yesterday, like I said, yesterday was a good day. Markets opened kind of opened up, sold off, hit on support yesterday, and then rallied into the close. So yesterday was actually technically a bullish day as well.
You're right. The second half of yesterday.
The second half of yesterday was bullish. So, but look, here's the thing: is that I think everybody needs to stop this whole bull bear thing and quit trying to figure out what's going to happen the rest of this year or next year, and sending me emails about the end of the world and all this. Look, nobody knows between now and 3 days from now what the market's going to do, much less what it's going to happen in the next 6 months or so. And the whole problem with trying to figure out bull or bear or whatever it's going to be is you're going to wind up on the wrong side of the trade at some point. So just stop that and just focus on what the markets are doing. And right now, everything since October has been bullishly biased. So just allow that to continue to play out until that changes.
Okay. Well, the interesting thing is I think everybody was worried it was changing as we were plummeting down towards that, lower bottom range.
No, it was just a correction in volume. Look, we didn't have a big pickup in volatility, right? So yeah, we were selling off, but volatility never spiked. Volatility started right around 2021. We didn't have big volume surges where, people were just like panic selling into the market. It was a very orderly correction. And so that's actually bullish too. When you're in a bullish trend and have an orderly correction, that's actually very bullish. So it's just, that's just the typical ebb and flow of the markets. We talked about stampedes last on I think Wednesday's podcast. We talked about buying and selling stampedes. And what these are is if you take a look at the market, you can have a period, and they generally last 15 trading days or so, 12 to 15 trading days. They can go longer. We've had longer ones that last 20, 30 days. But on average, they last about 12 to 15 trading days. And so you'll have a period where the market just every day kind of advances. You might have one day where it's down, but then the next day it's back up again. So these buying stampedes last 12 to 15 days. And when you get to the end of a buying stampede, guess what you get? You get a selling stampede the other way, which lasts 12 to 15 days. We've been about 2 weeks now into this little sell period. So again, that's very normal, and that's very orderly for the market. So when you have these kind of buying and selling stampedes in the market that are within a rising trend, overall, that is a very bullish sign, and you want to pay attention to that.
Got it. All right. So, again, to our oft-repeated phrase here, the market doesn't necessarily care what you or I think it should do. It's going to do what it does do, and we just have to be monitoring what it does. And right now, it is looking like it is poised to go higher from here, at least in the short term. So we'll keep our eyes on that. Now, one of the things that some of the media are saying is a part of the a potential trigger for yesterday's bottom, right? If you put the technicals aside for a moment, was we had some recent statements from some Federal Reserve executives, and we both Raphael Bostic and Neil Kashkari out there. And interestingly, I think what they said, I would have put a bearish slant on it, which is saying, hey, we're going to have to keep hiking, and we may even have to hike higher than just 5% from here. But then Bostic said, I think maybe, pausing by July makes sense, right? And kind of very close to that utterance, the market kind of took off. And, this could be the market again, hearing what it wants to hear and assuming that a pause is super bullish when maybe it's not. And you and I have made that argument before. I guess let's start with that first. So is there a reason that a pause by July should be a reason for the market to perk up?
No, well, look, again, so let's we try to, this is the media problem, right? The media always wants to assign a reason for why something occurs in the markets.
Right.
So so let me give you a really good example. When I first started doing radio back in early 2000, so this is right after the financial crisis, the dot-com crash started, and I started doing radio. And this is one of the greatest examples of what I'm talking about, is that IBM in the morning, the stock was down 5% in the morning because IBM announced layoffs, okay? And the market had opened down that morning. By the afternoon, the market had rallied back, was in positive territory, and IBM was up 5%. It completely reversed the loss and was now up 5%. And now the reason that the media gave is IBM rallied because they're laying off 5,000 people. So, the problem is that we're always trying to assign a reason for why the market's doing something. But in reality, the market's rallying because we had 2.5 straight weeks of selling. You just literally got sellers flushed out of the markets. And so any little bit of buying and plus, look, remember, the vast majority of the market is driven by algorithms. Everybody's looking at the same levels. We're looking at that 200-day moving average, and so is every technical trading program out there. So when the market bounced off that initial bounce off that 200-day moving average this morning, that triggered every buy program across the board, and they started buying stocks. And that's why there's been a steady rally all day long. So as the market continues to bounce off that 200-day moving average, these buy programs are just steadily buying. Has nothing to do with what anybody said, right? But we want to assign it to that. But reality is it's really the algorithms kind of driving the markets. And yes, look, the Fed is going to pause. We've been knowing this for months now. They're going to pause. The question is when are they going to pause? And what does it matter? If they stop hiking rates at 5.25 or 5.5, that's not bullish for stocks. And it doesn't mean they're going to cut rates anytime soon. So, and again, if you're cutting rates, that's not great for stocks either. So there is nothing bullish in that statement at all. But again, we're always trying to look for a reason why markets are rallying. It's especially a technical bounce. That's it.
Right. And it's never just one thing, too, right? We all like to think that there's one explanation, cause effect, right? Oftentimes it's a whole bunch of things. But okay,
it makes good headlines.
Well, and also too, it's the world is searching for meaning here, so the questions are always going to be asked. But you answered the spirit of my question, which is, let's say for a moment, let's just take that statement in and of itself. Is that a reason that we should say, oh, things have changed for the bullish because he thinks?
No, actually not.
No, not at all. All right. Yeah, exactly. And then, of course, we can get to the bearish interpretation of that, right? Which is basically reinforcing that higher for longer is indeed going to stay, right? And that's what the market's been trying to ignore. And that higher for longer might even go a little higher for a little longer, right? That's pretty much what they're saying. So what was interesting, though, is here's a quote from Bostic. I want to be completely clear. There's a case to be made that we need to go higher. Jobs have come in stronger than we expected. Inflation is remaining stubborn at elevated levels. Consumer spending is strong. Labor markets remain quite tight. So what's interesting to me about almost all that information is, one, it's all lagging, some of it pretty darn lagging data that the Fed is looking at. Two, you and I have debated a lot of this stuff, right? To say maybe it's not quite as strong as the headline data is suggesting. And I'm going to get to some new retail spending in a moment, but yeah, when he says consumer spending is strong, I guess maybe he's referring to the January retail sales numbers, which you and I have already picked apart.
Yep.
So anyways, I want to underscore for folks that he's looking at really lagging data, and we've talked about the problem of the Fed looking in the rearview mirror in the past, and that a lot of this, the strength of this data is highly questionable, and I won't revisit all the reasons why, because we've done it. We've again sort of eviscerated a number of these reports in the past. There's an image, a photo that I'll look to put on the screen here, Lance, from my interview yesterday with Tom McClellan, who was a phenomenal interview, folks, by the way. First time I'd interviewed him, wasn't entirely sure how it was going to go. Gosh, it's one of the favorite interviews I've done in a good long while. Just super great insights, especially if you like charts and data. So if you haven't seen that, folks, I'll put up a link to it here so you can go check it out later on. But he's got this picture to kind of reinforce the importance of being forward-looking rather than looking at lagging data. And it's these two vehicles speeding towards an underpass, and the front vehicle, the back vehicle is a convertible, and guy's happily chatting to his girlfriend driving it. The car in front of them is like a pickup truck with two big porta potties on it. And you can see that the underpass the truck's about to go under is too low. And so it's about to hit the porta potties, and the people in the convertible are about to get a really nasty surprise, right? And his whole point is if you're not looking forward and paying attention, instead if you're looking backwards, you can really get some nasty surprises. All right, so I want to get to a chart here that was put up by Simon White, I believe, from Bloomberg. It's from an article titled "Key Yield Curve Signal Shows U.S. Recession Due as Soon as June," and this is talking about what you were mentioning briefly last week, Lance. Right? It's which we're beginning to see the yield curve, starting to uninvert. Moving towards uninversion. And you've always said
troughing is the right word.
Troughing. Okay, yield curve is troughing here, and this is key yield curve, the 3-month versus 30 years, which is a very sort of predictable recession predictor. And when it troughs like this, that is when you're about 5 months away from recession, right? You were talking about this last week, so I just want to visualize this for folks, that this is the lit fuse that we were talking about last week. So if history is any guide here, and this data still maintains its correlation, we should be looking at July for like the real arrival of the recession in force.
I would be very careful saying that. And I'm not saying that this time is different, but when we talk about averages, right? On average, when this signal triggers, you have about 5 to 6 months to a recession. I would not make bets based on that this time. And does the signal mean we'll have a recession? Yes, there's a very good probability it could be delayed 9 to 12 months. And the reason is because there's still so much liquidity in the system. You take a look at M2 as a percentage of GDP. I think we talked about this last week. Take a look at just the remaining, the amount of M2 as a percentage of consumer debt is still very, very elevated right now. So again, there's just a lot of liquidity. And I was explaining this on our radio show on Thursday. So you're making me have a lot of references back this week. You're asking me all the same.
That's good. Folks should watch your radio show or listen to your radio show.
Well, yeah, you can watch it. It's more fun to watch because we mess up a lot. But no, the point is, and we were talking about this earlier this week, is you have to remember how money works in the system. And we talk about monetary velocity, which is how fast money goes through the system from when it's first spent, et cetera. And so when we talk about these recessions and things occurring, one thing just to keep in mind is there could be a delay because $5 trillion, we put $5 trillion into a $20 trillion economy, right? That's, 20% of the economy we just hit with liquidity in basically a year, right? And so so you give me a check for $1,500. And then I go out and I buy something from Adam for $1,500, right? So now Adam has $1,500. Well, he takes his profit out, which he then goes to spend on something else, right? More inventory or, whatever he wants to do. But he has to pay the employees that help build whatever product was I bought from Adam. And then he has to pay his suppliers for the components, right? Well, so that money takes time to go through, and it gets to those people then spend it, which gets to other people. So when you have $5 trillion and think about it in a bucket and you poke a hole in the bottom of the bucket, it takes time for that liquidity to flow out through the system. So it's getting diluted in the system. And the economy is definitely going to slow down because of that dilution of liquidity, but it's going to take time to pass through the economy. That velocity or that momentum of that money is going to take time to slow down. So the signal is right. We will have a recession. I just want to caution you not to go out and jump off a limb and say, oh, it's going to happen on July the 1st because, that's what the average is. Be careful with averages. That means that there's been longer times and shorter. It could be next month, but it could be 9 months from now too. So just be cautious.
All right. So to the spirit of your point there, which is an important point, right? We've talked about the pig through the python effect and all that stuff. You're saying that it may be prolonged, right? More prolonged this time because the pig is still just moving through the python because we shoved so much darn pig into it. Would you take the over on this one?
I don't think, again, this goes back to what we said earlier about managing money. When we're managing money, right, we don't make bets, right? We try to make educated guesses. And that's really a lot. That's a very fine line, by the way. That's a very fine line, because really, what is a bet? A bet is something I'm basing on probabilities. But betting in the terms of, when I'm betting on a hand of poker, I can bet on a pair of twos. if I think I can bluff the rest of the table. So that's a calculated guess, right? But that's what I consider a bet. There's a very high probability that I might lose, but I'm willing to do it because it's a game of chance. When you're investing, we want to take the data we have available and make the highest educated guess for the best possible outcome that we can make, the one with the highest probability. So in other words, if I had a pair of twos, and if the bet on the recession is a pair of twos, I'm not betting at all, right? It's just not a good bet at this point. And so when we're thinking about these things, set a lot of these big macro issues aside, and they can impact they can influence, I should say, your decision-making process, but don't make your bet on that data, because these things can take a lot longer. There's an old John Maynard Keynes saying, right? The markets remain irrational the longer you can remain solvent. And that holds true more often than not. So I'm not taking the over or the under. Right now, the markets are going up. We're invested. We're participating. We've hedged our portfolio a bit. We've reduced some risk early this month, so we've got some extra cash. We're looking for an opportunity to redeploy that cash. But when we start to see the signs of the recession really starting to kick in, and we begin to see earnings and profit margins decline at a more accelerated pace, we'll greatly underweight our portfolio and equity risk at that point. We're just not there yet. And that could be 6 months from now. It could be 9 months. It could be next year.
Okay. We'll be talking about each of those signs here on this channel. And I would say this is a sign, right? The fact that we're troughing is a sign that the fuse is lit. Right now, we can just argue over how long the fuse is, but we can say, hey, confidence that there's going to be an explosion at the end is now higher because we see the burning fuse. Absolutely.
And that was the whole crux of my newsletter last weekend, right? So, when I wrote the newsletter, published it on Saturday, the whole crux of that newsletter was the recession clock has started. But again, the conclusion of that is we still have to manage because we don't know the time.
Right.
It's always the factor of time that's the issue. It's not whether or not we're going to have a recession. I will take the over that we are going to have a recession, and you can almost bet money on that. There's a very high probability we're going to have a recession. Could we avoid one? Yes. Very high probability we won't, like 90% probability we won't avoid recession. The question is when. And what will happen with most investors is they will bet on a recession happening in 6 months. And when it doesn't happen in 6 months, they're going to reverse their course and say, well, see, that Adam was entirely wrong. And damn him, he made me lose money. They go back in the market long, and then that's when the recession hits, right? Yeah. That's just the way investing works. And, I can tell you a great story. One of my first option trades that I ever made was on Intel. And my options expired in February, and the stock, I've taken a put option on Intel to miss earnings and have a big decline. And my option expired in February. In March, they missed earnings and declined by 50%. So, timing is very important.
Is everything. Yeah. Hey, and just to be super clear, I brought up the Bloomberg chart to say that confirm your point that the fuse had been lit, and that the data suggests historically that it's 5 months. And again, I took pains to say, if history is a guide and we see a repeat. I am not saying guaranteed it's by July. I don't think anyone really took that, but just to be sure.
I know, don't worry. I'm gonna write it in this weekend's newsletter that you said.
Yeah, I'm sure you will. All right. Well, look. So I've got a bunch of data points, several of which are sourced from you, that are signs of where we are along the way, right? And it is going to be interesting. We talk about this every week, right? It's such a tough time because things have been so uncertain. Starting with the removal of all the props to the system, right? We shut off the stimulus spigots, we shut off QE. We've actually reversed things, right, by hiking and now QT and all that stuff. So it's a different world than what investors have been used to. Folks lost a fair amount of money last year on average, right? This year is looking highly uncertain, but it's interesting because we're getting, I would say, sort of like worsening data, to your point, which would make a rational person think, okay, well, then I got to get more and more defensive, which may be the right thing to do in many people's cases. But it doesn't mean that the market can't be rallying for a good period of time here, right? And you as a capital manager, and I know this is why you're reinforcing the points you are today, is, look, I got to be out there doing the best thing for my clients as I can in this environment. And, looking at a lot of the near-term data, you're saying, hey, we're not seeing thunderstorms yet. In fact, the sun might be coming out more a little bit in the short term here, right? So that's the role that you got to play. But big part of this channel is to try to just pull as many data points in and tell people what we think is happening, right? Both short term and longer term. All right, so I'm going to get a macro question here, and then I'm going to pull up some data. So Nouriel Roubini, which, if you're not familiar with him, he was a presidential economic advisor during the Clinton administration, and he was a senior economist, our senior advisor to Tim Geithner, right? Who then, was Secretary Treasury, and Tim was in a key role during the whole great financial crisis and stuff like that. So Nouriel's kind of been close to the folks who've been running the system. He does have he earned this during the global financial crisis. He has a reputation of calling a spade when he thinks the economy is going off the rails. And he's doing that right now. So here are a couple of quotes from him I just wanted you to react to. He says, now we're facing the perfect storm: inflation, stagflation, recession, and a potential debt crisis. Seems to me from reading his work, he does think the Fed is going to pivot at some point, and because it's going to be forced to by these things. It's going to be, as you and I have said, it's not going to be a willing pivot. It's going to be a gun to the head. You got to do this because the world's burning, right? He thinks that stocks will continue to go down. In his words, quote, the market is already correcting. So maybe he's got a difference of opinion with how we see the short term here. And then he urged investors to protect themselves by choosing inflation hedges, such as gold, inflation index bonds, and short-term bonds. He thinks stocks and bonds are likely to suffer as the year progresses here. I'm curious any reaction in general, but most importantly, I want to dial into this inflation part, because that was another quote I didn't mention from that Bloomberg article. That was inflation was something both Bostic and Kashkari mentioned, and then in that Bloomberg article, the author wrote, this time around, the rise in long-term yields is particularly troublesome because it suggests the bond market is beginning to price in structurally high inflation. So again, curious your general reaction, but this point about inflation, I mean, do you have a strong sense one way or the other as to whether inflation is going to be more stubborn to control than the Fed is currently anticipating?
Well, yeah. So inflation is so a couple of things. If you take a look at inflation, it is starting to see a little bit of a resurgence. We saw PPE tick up. We've seen the unit labor costs have also risen here. So that's one of the things that are feeding into inflation. That's also one of the Fed's biggest fears. I've got an article coming out of this, I think next week, talking about the Fed's biggest fear, which is the wage price spiral. That's where wages keep going up, and then that fuels more inflation. That's one of the Fed's biggest fears. So, there's certainly inflationary pressures that are remaining in the system because of all this liquidity. Again, when you take a look at M2 as a percentage of GDP, it's at a very high level, and that is helping sustain inflationary pressures at this point, at least for the time being. Now, that will reverse. When you get into a recessionary drag in the economy, you will get further deflationary pressures on everything, because at that point, the process of demand drops. And this has been the big challenge for the Fed is, look, why has the Fed been hiking rates? They want to impact the consumer. And, Elizabeth Warren and others have been out there, pounding the table like, how dare you say you want to cause pain to the average American? Well, unfortunately, to fix inflation, you got to have a recession. That's just kind of the byproduct. The reason we hike rates, make things too costly, you have to spend less because you don't have the money, and that brings prices down. It's just the basics of economics of supply and demand. And yes, inflation has remained a bit stickier here than what you would expect, but the economy has remained stickier than what we would have expected post that financial input. So a lot of our analysis last year was based upon this extraction of liquidity from the economy. The economy slows down, but yet the economy's been able to kind of chug along here, 2.5% a quarter, because that liquidity is sticking in the system longer than we expected that it would. And therefore, the byproduct is that inflation remains stickier as well. That will end. It's just a function of time.
Yeah. Oh, I guess we're back to a function of time here, right?
Yeah.
But I think, I recall just from the last week's video, we spent a fair amount of time focused on the lag effects and, a lot of things that are going to bring inflation down. And actually some of the inflation metrics, you look at CPI, the biggest number in there, I think it's still the biggest number in PCE too, which is the Fed's favored metric, is the shelter data, which is seriously lagging, right? It's much more reflective of the housing market like 12 months ago than it is today. And we know from real-time data, the housing market is really struggling today. So a lot of that stuff is going to come down. But, there are a lot of smart minds out there that are saying, hey, it's not going to be, Fed can't start getting confident yet that everything it's done is going to be a tractor beam pulling things down, that inflation, is seemingly a little bit more resistant than that. So we'll be watching this pretty closely going forward. Okay, so that said, we talked about retail spending when the January numbers came out, right? And the headline numbers were great. Got a lot of touting on that, and we saw a nice bump in the stock market as a result of that. But we talked about how they were largely driven by a bunch of seasonal adjustments, and they weren't inflation adjusted. And when you did adjust them for inflation, they hadn't really gone anywhere, right? So I'm going to put up a chart here of some recent retail spending data from March, which shows a pretty dramatic slowdown. The year-over-year increase over the past 2 weeks, has only been about 1.3%. That compares to 3.8% for the period before that, right? So we did see a big surge not that long ago, but it really seems to be petering off here. And if you take out auto spending, the year-over-year decline was actually negative. So there just seems to be, a quick ramp down here. And, it does open the question, as we were debating the other week when we were seeing the original data, which is A, how real is this? And B, how long-lived is it? And it doesn't seem to have been that long-lived. Now, TBD, this could just be a dip. We'll keep watching this as it goes on, but it seems to be reverting back to the trend that we were seeing pre-January, which is that retail sales have been tracking downward for a good long while. I've got some pretty mind-blowing stats around autos and housing. But before I get into the specifics of those sectors, Lance, I want to give you a chance to opine a bit about just sort of corporate earnings in general. So consumer spending is, close to 70% of GDP, as we remind people often. As that potentially slows down, and I just shared some data that suggests it probably still is, that's going to compress corporate margins along with their cost of capital and their wage costs and their other input costs that are going on here. So famously, Jeremy Grantham said that corporate profits were like the most mean reverting series in finance. And I think he said something like this, because I think your title was a riff on it, was that if they don't mean revert, it means something's gone badly wrong with capitalism. So the title of your recent report here is "Capitalism is Broken If Record Profit Margins Don't Revert." And you've got some great charts in here. So can you just sort of highlight your key takeaways from that article for folks?
Well, yeah. So there's obviously, and what was interesting when I posted this article, I get a whole bunch of emails about, see, I told you capitalism was broken. And actually, that's not the function of the article at all, which is actually saying capitalism is alive and well. And one of the few people that got it right was, Charles Payne, who interviewed me on Fox Business on Thursday about that article as well, because he's like, I get it, right? Capitalism has to work. And if capitalism is going to work, then it's all based upon, what happens economically, and that comes into earnings. And that's absolutely right, is that, look, earnings are a function of economic growth. That's it. So when we talk about GDP, what comprises several components? Expenditures makes up about 70%. So it was like 68%, but roughly 70% of the GDP calculation is what you and I spend. 40% of that 70%, or 40% of that PCE number is made up of retail sales. So again, that input into GDP, X out everything else, right? Which is net exports, government spending, business investment, strip out those things, and you'll still get a pretty high correlation between spending and economic growth, because that's the big driver. So if demand is going to slow down, earnings and profits have to slow down as well, because it's just a function of economic growth. That's where, where does a company, let's go back to my example a moment ago where I was spending $1,500 on a product from you, Adam. Well, that's where your revenue comes from. You didn't magically get $3,000 or $5,500. You got $1,500. That's all you got after you pay all your expenses, your payroll, your healthcare costs, your taxes, everything else that you've got to pay, and pay your suppliers. Whatever's left over is your profit margin. So that too has to decline if earnings slow down, because if I pay you $1,500 and you were getting 5 orders, your labor doesn't really change much. So if you're paying your wife $1,000 as your labor, her payroll doesn't change. But if your orders go from 5 orders of $1,500 to 1 order of $1,500, your profit falls, your earnings fall dramatically.
Right.
And so that's ultimately what's going to happen. And that's capitalism at work. And, it's interesting because people go, well, I got a great email today debating me on this article saying that, well, see, this is the whole problem with capitalism because, these companies have record profit margins, but they're not giving people big wages. And that's big wage increases. And that's true. But that's also capitalism because, where the problem is as a labor provider, as we as individuals, as employees, if we are just the employee of a company, we are only providing labor. That is what we are being compensated for, is our labor. The capital provider is taking all the risk. They take the risk of having to meet payroll. They take the risk of changes within the economy. They take the risk with everything else that occurs.
Lawsuits,
interest rates, lawsuits. Exactly. They take all that risk. Now, here's the interesting statement about this, though, is that as a labor provider, right? So we want an equal share of the wages that are being, if a company's making record profit margins, we should get paid more. I'm actually okay with that, except from the basis that if I start to lose money, you have to be willing to take a pay cut.
Right.
And people don't want that. We, as employees, we want stability. We want, hey, I'm making $50,000 a year. I want to make $50,000 a year. Don't come to me and tell me you can only pay me 40 because you promised to pay me 50, right? So this is all part of that capitalistic process that ultimately, as the economy slows down, and as this liquidity comes out of the system and inflation starts to come down, now one of the drivers of these big profit margins, we've had a record surge in profit margins due to inflation as part of that component, because as inflation went up, we were able to charge more. And at the same time, we had less employees because we fired everybody, going into the pandemic, right? So we had less employees and we had this massive surge in inflation, which led to higher prices. Well, as inflation comes down, profit margins must decline because you have less inflation in the system. So pricing power goes away. Employment costs don't change. In fact, I've hired more people now. We're back to pre-pandemic levels of employment. Wages are up. So I'm paying people more, plus benefits, plus insurance, plus everything else. So all that's going to eat into profit margins and earnings. And so if somehow miraculously those profit margins don't revert, we've got a bigger problem in the overall market. And that's going to be the fact that basically we're bailing companies out if those profit margins don't revert.
Okay. And I want to put up a chart here that you have in there that shows how far they have to fall. Right. So just so people know that, they're at these record levels.
Yeah.
And if, we get the recession that we think is going to happen and Powell's campaign of demand destruction, works and whatnot. I take from this chart sort of like, look out below, right? In other words, like if corporate profits fall as far as they could here, that's going to obviously impact earnings, right? And its profits are earnings, right? And that's what stocks are based off of. So from a market standpoint, and you said it's all about timing, Lance, but we got to be careful that if that shoe does drop, well, then as it does, stock prices are going to come down commensurately with it.
Well, it's interesting. So if you go back and look at 2008 is a good example. Earnings dropped. PEs went to like 180, right? On a yearly basis. I'm not talking about tape, right? I'm just talking about for the year. And that's because earnings fell through the floor and prices were trying to catch up. And, that's what will happen here. Ultimately, right now, looking at GAAP earnings, and actually in this weekend's newsletter that I'm writing right now, I've got a chart on operating earnings versus GAAP earnings. And there is a big gap right now between operating, which are called adjusted earnings. I call them bullshit numbers because they're all basically just earnings with with nothing bad included in them. This is, adjusted earnings are everything went exactly as I expected. And here we go. And by the way,
to perfection earnings. Yeah,
exactly. And by the way, when you look at FactSet, everybody refers to, FactSet earnings did this and blah, blah, blah. FactSet uses adjusted earnings. They don't report GAAP. So whenever you look at the FactSet data, it's all adjusted earnings. It's all these operating BS numbers. It's the worst source of information you should look at when you're looking for corporate earnings. Go to S&P, look at their earnings. That's GAAP. That's after all the bad stuff is in there. Much more realistic picture of what you're paying for. But right now, using GAAP earnings for the end of 2023, they're expecting $199 a share. Okay. The long-term median growth of earnings going back to 1950 is about $157 a share right now. So if you just revert back, and by the way, historically in every recession, you revert beyond that long-term growth trend. So if you just revert back from 190, just call it 200 to 160, right? That is a 20% decline in earnings from where we are right now. That is not minimal when you look at a market that's still pricing at 21 times earnings right now. If earnings fall by 20% and prices don't move, you got a problem, right? Because prices are going to have to fall to compensate for a much lower level of earnings, which will come during the recession. So again, a lot of these expectations is that earnings will trough this quarter for quarter one. Earnings will trough and then begin to recover by year end. And if you have any type of recession at all, that's not going to happen. Yeah.
Okay. I'm going to put up a scatter plot chart that you had in your article as well. That's kind of helps show this too, which is to show just sort of how far the deviation is still today from where we, where the majority of years come into this dot plot, right? So you've got Q1 2022 out there really is that's as good as it gets, right? In this entire data series. You can see where we are in Q3 of 2022. We're beginning to kind of move we're how do you want to call this? We're earnings are beginning to come down a little bit. We're coming we're still not even though really coming much closer to the actual trend line. Right. So basically what you want to see at some point is that, wherever we are is going to be on that trend line at some point in time. If historical means happen, as you said, we generally overshoot. So we'll probably punch below it at some point. So, yeah. So
and I think that's look. And if you take a look at earnings estimates, earnings estimates are falling like a rock. We were at 200. So in June of last year, just 7 months ago, analysts thought that the end of 2023 would be $242 a share. We're now down. Now we're down to 199 in 6 months. So, and we're still priced at basically the same level. We haven't really changed pricing a whole lot at this point. So, it's a function that investors have not caught up with the reality is that, and again, just as an investor, let's just set everything aside we just said a second ago. The problem with forward earnings and why you should never use them is that in June of last year, analysts said that companies were going to earn $242 a share by the end of this year. So you bought companies going, man, stocks are cheap. They're only 16, 17 times earnings. They weren't cheap then, and they really aren't cheap now. And so those earnings, if you're buying stocks today expecting $199 a share by the end of this year, you're going to overpay for assets. So again, this is why it's so critically important. And then look, and it's far worse if you use FactSet data because that's adjusted earnings, and that's even higher. So there's a big gap between FactSet and GAAP right now that's going to have to close, and it's not going to be GAAP getting better. It'll be adjusted getting worse.
Well, and this is why active management is so important these days, right? Because what you got to do is you can't rely on buying the sector ETF anymore. Right. Because of this, the sector ETF is assuming these average earnings rates. Right. which, as you said, are really not that realistic. So what you got to do is you got to look within the sectors that you think make sense. What are the companies that are well valued right now, right? Where you can really get them at a much more reasonable, rational, sane price to earnings ratio.
Yeah, no, that's right. And in fact, if we have an article out today on SimpleVisor. Here, let me share a screen with you real quick. I'll show you something that's interesting because we're working on that exact premise right now. So we actually have an article out this weekend, actually on Friday on SimpleVisor, talking about this very thing because, again, the importance to your point and exactly what you're talking about is this whole idea of having to dig through a sector and then figuring out what stocks are going to trade. And so we're talking about factors that are in favor right now in this article. And one of the things that we're really looking at is the difference between mega cap growth and value. And these have a very high non-correlation with each other. And so when basically when everybody's chasing mega cap growth, the NASDAQ, the Apple, the FANG stocks, et cetera, value stocks typically don't work out well, and vice versa when they're under pressure. And so when you take a look at these divergences between markets, and then again, this is just the setup process to go start digging within markets to find out where opportunities are. Right now, if we go back and we say, okay, when mega cap is no longer performing and there's a big deviation, then we want to own value. And when value is no longer performing, we want to switch back to mega cap growth. And when we look at strategy performance over time of just making those switches within portfolios, you can see that you start getting a significant outperformance over the market as a whole by understanding that there is a rotation within the markets based upon earnings growth, disinflation, economic growth, et cetera. And that's what drives these changes within the overall markets. So, we're seeing that exact same kind of setup going right now, which is why our portfolio is heavily tilted at the moment towards value stocks more than they are growth stocks. We still own some growth stocks like Apple and Microsoft and those companies, but we've been adding a lot of value lately. We talked about here on the show, Stanley Black & Decker and T. Rowe Price and Altria, with big boring companies with dividend yields. But those tend to perform better if we're going to get into a slower economic environment later this year.
Okay. All right. Well, let's talk about the potential for a slowing economic environment later this year. So, I gave some macro stats earlier. I want to give a few more, but ones that are sector specific. All right. So looking in the auto industry, we've got some really big trouble brewing there right now with auto loans and with everything, really. If you look at, I was pulling the numbers the other day for auto sales volumes and used auto sales volumes and used auto sales prices. And they've pretty much been on a downward trajectory since like the first half of 2022. There was a little bit of an uptick in January. People were trying to make a lot of news out of that. That's already seemed to have rolled over again. So just sort of the health of the industry from a purchasing standpoint, not great. We actually started to see some slowdown in new car sales and new car prices as well, which had been hanging in there pretty robustly until recently. But I want to put up a chart here. I think I mentioned this the other week, but this is an updated chart. The subprime loans in the auto space, and my God, this is just like the subprime housing space back in the great financial crisis, where during the pandemic, they were just giving loans to anybody who, had half of a pulse and could maybe halfway fog a mirror. And we're already beginning to see the repercussions of that. So this chart shows that the subprime 60-day defaults are not only spiking, but they are now higher than they were during the great financial crisis, right? So while the train is still on the rails, right, we're seeing the worst default ratio than we've seen in this millennia so far. A big issue that all of a sudden is being talked about in the auto space is negative equity, right? Car prices got so incredibly expensive, and I'll talk more about that in a second, that now as the prices are beginning to come down, but the loan values were so high and the costs of the loan is so high, is that people are coming in to trade their cars in, and they're actually upside down in their cars, right?
Well, no, we talked about that, probably 2 years ago on our radio show. So right when we did all of these, funny money distribution stimuluses and all that, and everybody was running out to buy cars, we go, this is going to work out very badly because people were financing cars. So look, how long do you normally own a car? The average car ownership is about 3 years. People can hold them longer, and certain, I'm one of those.
My household certainly does. Yep.
Yeah, I will drive it until the wheels fall off and then go buy another car, right? I hate cars. They are a terrible investment. I drive cars that cost less than $20,000. I don't have to worry about trying to take care of it. I take care of it, but I don't have to worry about it. And if somebody dings it or scratches it, whatever, right? It's just to get me from point A to point B, right? It's stupid to go out and spend, there's been a bunch of articles about how people are paying on average $1,000 a month for a car note. Are you a freaking idiot to pay $1,000 for a depreciating asset? And it's because, look, but we've told people this, right? Oh, you got to drive a nice car. You get on social media. Social media is the worst thing you can do for your side now financially. I mean, everybody goes, well, I need it to keep up with my friends and family. That's what a telephone is for. Call your friends and family, go to their house, have lunch with them. They would prefer to see you in person anyway. But, we get bombarded by all these ads. We got to go buy this. And of course, you see everybody on LinkedIn standing by their Porsche or their Lamborghini or, hey, look at what new car, but you didn't buy that car. But, this is what we see on social media. So we have to keep up with the Joneses. So we go buy these super nice cars, right? And it's ridiculous. It's just to get you from point A to point B. That's it. I mean, you're not living in the damn thing. Save your money for what you want in life, right? Anyway, side note, just frustration with that. Anyway, but we talked about this.
Okay, boomer.
2-3 years. I know, right? 2-3 years ago, we said, look, this is going to wind up a huge, and look, it's just start. By the way, Adam, the stuff you're talking about is just starting. People were financing cars for 7 to 9 years. Now, you don't keep a car that long in most cases, and values for cars don't last 9 years. And so if you've got a loan that amortizes over 9 years, the value of that car is not going to keep up with the depreciation and amortization of that loan over that 7 to 9 year period. So the amount of negative equity that people are going to wind up with trading in cars is about to be a monstrosity across the board. Because again, most people, even before this, were rolling negative equity. I buy a car, I get a 5-year loan on it. I drive it 3 years. I traded it on the next new fancy car. And it's like, oh, well, you still owe, you've got negative equity of $3,000-$4,000, whatever it is. Okay, I'll just roll it to the new loan. They'll make you a deal on it and you just keep going, right? Well, that keeps rolling. Well, now the problem is that negative equity is going to be so large that you may be able to roll it over once, but eventually you're going to get to the point where you can't roll that negative equity at all. You just simply won't be able to afford it at some point. So there's a whole lockup for the auto industry that's coming based on that negative equity. And it's something that nobody's paying attention to.
Yeah, I think it's something we're going to start seeing a lot of in the media pretty soon as the human stories get out there.
Yeah.
But you're right, the chickens are beginning to come home to roost, and they're big chickens.
Yeah, and everybody's going to go, oh, well, this is, poor them. This is, that should have never happened. And we're going to need to bail all these people out again because, just like taking out a student loan, we all held guns to their head and made everybody take out a student loan. So, now we got to bail them out because it wasn't their fault. They took out student loans to, go to Cabo San Lucas for the weekend. But, it's the same thing with cars. It'll be, oh, poor pity me for making a bad financial decision. Now we got to go bail all these people out and bail out the auto lenders that gave the loans because they're all defaulting. This is what we did with home mortgages back in 2008. We just keep repeating this process. And honestly, I don't know why I care about people taking out a bunch of loan and getting in debt because we keep bailing them out. Why not? If you're going to get bailed out, why not go take it out and just, do whatever?
Well, and that's the moral hazard that these bailouts engender. And then they create the social strife of people like you and me who did the responsible, and most of our viewers here did the responsible thing. And then they watch the people who were irresponsible get protected and rewarded. That is not going to be this week's rant, though we can easily make it one going forward. I do want to get to some additional data here, but you're making me think of this. I'll see if I can find it. And apologies, folks, if I can't. But I saw on Twitter the other day, It was a woman who was celebrating having just signed a lease on her 1998 Ford Escort, something like that. It's a car that old, right? And it's like a $300-something lease, and it's like a 10-year lease or something like that. So the car is worth maybe $3,000, and by the end of her lease payment, she's going to be paying like 30 grand for this literal piece of junk that's probably going to break down in 6 months and die anyways, right? It just seems emblematic of the issue that we're talking about here. But some additional stats on this just to show you folks how bad this is. So recent Edmunds data shows that average net equity on trade-ins is approaching 5,500, which was the highs that we saw during the pandemic, right? So again, this is negative equity. These are average people bringing in their cars when they're trying to buy a new car, and then finding out, oh no, sorry, bud, to get rid of this thing, you got to pay us a hefty amount of money, thousands of dollars. So from an affordability standpoint, and this is presaging what I'm going to talk about in a second in the housing market, purchasing a new car is becoming less and less feasible for the average person. As you were saying, Lance, approximately 2 out of every 13 individuals are making monthly car payments of $1,000 or more. I mean, what a ridiculous cash flow outlay to spend on something that should just have a practical transportation function for you. The average loan rate for new car loans just hit a 13-year high of near 7%. And the momentum is continuing to go higher, right? So we're having, I don't know if it's a record high. It's probably not record high auto loan rates yet, but we're headed there, right? And we already have record high other revolving credit debt for consumers, like their credit card debts. So just a headline here: most Americans can't afford their car payments. More Americans can't afford their car payments than during the peak of the financial crisis, right? So again, train is still on the rails here, and we've got fewer people who can make their car payments than could during the 2008 great financial crisis, really showing where we are in the story. And here is a quote from a professor at Suffolk University: because these car loans are generally unaffordable at the outset, that means that every month borrowers are getting closer to the financial edge. So, the big issue here, right, is that car prices exploded for a host of reasons from the pandemic, right? A lot of supply issues, but also just we gave people a ton of stimulus money, and what were they going to do? They were going to go buy a fancy car with it, right? And then we gave them these loans on these overinflated prices at pretty rapacious rates that are now going higher still, right? So her point is a very true one, which is like, this is like on a fuse too, basically is what she's saying. These cars got sold to people who no way could make those payments sustainably. And every month that goes by, more and more of them blow up and say, okay, I can't do this anymore, right? That is the tsunami coming our way here.
But that is also what was the catalyst for the subprime crisis, right? We gave loans to people who could not afford houses, but when they figured out they couldn't afford them, then they all blew up. And here's the thing about all this. We have everybody wants to complain about capitalism, right? Capitalism sucks. It's not fair. Everything costs too much, blah, blah, blah. We have the power to fix all that, right? But it's interesting, your phone costs $1,000, right? Whatever an Apple iPhone costs now, $1,200, $1,500, whatever it is. And we go buy the damn thing rather than buying a $300 phone that will do the same thing of making calls and sending a text.
Right.
We could destroy Apple, right, by stopping buying their products, but we won't, right? Because we want to have the latest gadget. We want to complain about capitalism and how it's so unfair. And it was great. I walked into a coffee shop. My daughter is working at a coffee shop part-time right now. Because I require them to do that because they have to pay bills, even though she's 16. And
that's so capitalist of you.
I know, right? She's and she missed her car note last month. And so I called her up and I said, by the way, I'm going to have to repo your car. You've missed your car payment. She goes, what do you mean? I said, well, if you miss your car note more than 2 months in a row, I will come and take your car away from you, because that's what will happen in real life. Oh, and by the way, your car note now has a penalty on it. It will now be $200 this month rather than the $150 note because you're now late. So she's very upset with me right now, but she's learning the lesson about paying bills and being responsible.
That is an important lesson.
So I went to go see her to buy a cup of coffee, and I always tip her very well to help her out, So I buy a $5 cup of coffee. I give her a $20 tip. She's very happy with that, right, when I come in. But I looked over, and there was a girl sitting at a table by herself. And this is, talking about what we're talking about here. And she's got a set of keys sitting on the edge of the coffee table for a Lexus. And I looked in the parking lot, and there was a Lexus GS350 sitting in the parking lot. So I assume it's hers, right? Just there was no other Lexus in the parking lot, just that one. So I'm assuming it's hers. She's got an Apple laptop computer. She has an Apple iPhone attached to Bose headphones, and several other gadgets on the table that she's all connected to the universe. And she's on to her Apple laptop on Facebook, LinkedIn, and Twitter, complaining. Her shirt says, "Save a cow, eat the rich." But everything she's doing is supporting the rich, right?
Living the rich lifestyle, yeah.
Well, not living the rich style, but she's buying all the products from the people that she's complaining about. It's the very same thing about, climate change, and we want to fix the climate and all this. That's great. We've made Elon Musk the richest man in the world by buying his cars. So, right. We all want to complain about capitalism, but that's capitalism, right? We said, hey, here's a problem. Climate change is a problem. Elon Musk goes, I got a solution. We all go buy his product to fix that problem. Whether or not you agree that's a problem or not, that's up to you. But we make him rich by doing it. That's capitalism. That's the way it works. We as individuals, we have the ability to fix that. Stop buying Teslas, stop buying Apple iPhones, stop buying Apple computers. And those companies won't be around in business for very much longer. We have the choice to make financial decisions. We just don't want to make those financial decisions because we like the convenience of what we get for buying those things. But that's capitalism at work. And so going back to this original conversation, this is all going to feed on itself, right? The reason that we're rolling negative equity, and when you get to houses, we'll talk about the National Association of Realtors just had a beautiful article last week. I railed on this on Wednesday's show about the National Association of Realtors when it comes to home ownership. But we want to have all these things because the media tells us we have to drive a Lexus. We have to have an Apple iPhone. We've got to have an Apple computer. We've got to have all these things. We don't really, right? We have needs and we have wants, and we kind of go overboard with our wants and financially ruin ourselves. Then we want to complain about capitalism not working because it's not fair, right? Because we don't have any money.
Yeah. Well, and it's funny, this is sort of where I thought you were going initially with your anecdote there about the Lexus and the Apple and the Bose headphones and stuff, which is, presumably every one of those things could be substituted for something that does the same job just at a much lower price, right?
Right.
And we have come off this decade plus of ever increasing prosperity coming out of the great financial crisis with all the stimulus and everything and all that type of stuff. And we have departed from the mindset that we had at other times, right? Like during the Great Depression or during the 70s when inflation was really, high, where there was a sentiment shift from indulgence to economy, right? And we very well may be having to be forced to go through one of those shifts again. And I don't know, that might provide some interesting investment opportunities in the companies that are providing the much cheaper computer because it doesn't have an Apple logo, but it does all the key things that we need. Like, I have noticed amongst my my kids' generation, they get Chromebooks. They get to borrow a Chromebook from school, right? And when they've asked me for a computer, I've said, okay, great. Well, do you need a computer or do you just need a Chromebook? Right. And they're like, oh, well, I want a computer. And I ask why, right? Well, are you going to be writing software? Are you going to be doing, big programs that demand a lot of memory? And in most cases, not. And I'm like, well, a Chromebook does all that for you, right? And it's a fraction of the cost. And in their minds, it's just, that's just kind of like,
it's not what their friends, it's not what their friends have, right?
Yeah, exactly. It's not cool. Yeah, exactly.
No, that's it. And see, but that's the media, right? That's how we've ingrained, all this advertising that we do. And look, take a look at the ad revenue for Google and for Facebook. Billions upon billions of dollars spent on digital advertising to get something in front of you. And we joke around, this in our house a lot, because we'll talk about something in our house and all of a sudden it's showing up on your phone. You're getting ads for whatever we were just talking about 30 minutes ago.
Right.
Pop up. But that's the way this whole process works. And we put it in front of people and we say, oh, you can afford it. And we did this back in 2008, right? No income, no job loans. Don't worry, you can afford that $500,000 house. You don't even have to have a job, and we can get you into that house. And we go, wow, I can have a $500,000 house. And look, it's got crown molding, it's got fancy showers and all the stuff I never thought I could have. And now you're in it, and then the bill comes due, right? And so we don't educate people well enough about how to manage money and to grow wealth over time. You can have these things, right? There's nothing. I have a phone. It's an Android that's like 10 years old. It barely works. My family hates me because they can't group text with me, which between you and I do that on purpose. Be out of that nonsense. But the whole point is that's not a necessity for me, right? That's, my needs are, focused on financial wealth building, running a business, and those type of things. That's what I find value in. And so we have to start making better determinations for ourselves about what is a want versus what is a need. And it's okay I have things that I want, right? I mean, there's things that I splurge money on because it's something I really want. Most of it involves lead bullets, but I have wants that I fulfill, but only when I can pay cash. I never do anything on debt or credit. And if I can't afford it, and by paying cash on it without crimping my savings, savings always comes first. So the first 50% of everything we make goes into savings. If I can't buy something without reducing my savings, I don't buy it until I can afford to save up for it. And that's just a function of how we operate our lives. And that's how we build wealth over time. The problem is for most people, it's always interesting is I talk to individuals about saving money. I go, okay, are you fully funding your 401k plan at work? No. Why not? I can't afford to. Well, there's your first problem. Yeah. You should be able to fully fund your 401k plan at work every year, and you live on the balance. And if you can't do that, you've got a cash flow problem at home. Let's start there. And that's where we start digging through. And the first thing I make people do is build a spreadsheet and track it for wherever they spend money. And then we go look at where they're spending money. And in the leakage, it's what we call financial leakage. It's $5 Starbucks, every day. And it's, eating out for lunch every day. And start and you don't realize it because it's just $5 here. It's $500 here for lunch these days. But, you start adding that up in a month and they go, wow, $1,500 a month is going to this leakage, or $1,000 a month is going to leakage. And it's a real eye opener for people at that point to see how much money they literally just waste every month.
Yeah. So we've railed a lot, and we can't rail too much on it because I'm looking at the time. We get to get through a lot more, but about just how, criminally bad our education system is at teaching financial literacy, right? Arming people with the financial basic skills to be successful wealth builders in their lives, right? And that's a big reason actually why I founded Wealthion. But not only do we not arm them well, the system is just geared to push you into bad financial decisions. And we've talked in the past about how, you're a college student, as soon as you turn 18, you're like a raw steak tossed into the lion's den of credit card companies, right? They're just, everyone's trying to get you hooked on a credit card. And they have this new thing now. Am I right? Is it pay as you go? Is that the new thing where, you're online and you want to buy something and they're like, well, the price is this, but you can get it. You can walk out with it today for $6, right? And whatever, 190,000 monthly payments at $6, right? Exactly. And all the person sees is $6 and I can get it now. Great. Sign me up. Right. So we just put, terrible solutions in front of them. And in most cases, like this poor woman who bought the 1998 Ford Escort, right? They just didn't do the math and they make the deal with the devil. And then it's only later on they realize, oh my God, this was a horrible deal. I just didn't realize it at the time. And so oftentimes it's the most vulnerable who are suffering the most. Got to move on from this though. Okay. So you talked about, we're seeing the same issues in the auto market that we saw in housing leading up to the '08 crash. And yes, folks, we did not learn our lesson, right? We're repeating the same mistakes all over again.
All over.
So the housing market still continues to struggle. And we talk about this every week, but I got some new data here. So first off, I just want to flag for folks that the 30-year mortgage has now popped back up above 7%. So everybody was cheering in, I think earlier in late January or whatever, that rates had come down a little bit, and they were like, oh, the housing issues are over and everything's going to be great again. No, and mortgage rates are back at historically extremely high levels. Housing affordability is at the lowest level in history. This is according to Redfin Deputy Chief Economist Taylor Marr. And importantly about this, they say, look, this is widening the wealth gap, especially between generations, also along racial lines as well, right? So, if you care about wealth equality, what's happening in the housing market, for years, as you and I railed about, Lance, has been widening that gap. But what's happening, particularly now, is the wealthy homeowners, especially those that are locked into 3% and are just holding on right now, they're doing okay. Whereas anybody that's trying to buy a home right now or rent, and I'm going to talk about those stats in a second, it's just getting worse for them by the day. I mean, really, and I've got some personal anecdotes around this I might share in a second. I want to show this housing affordability chart, though. I mean, you can see here, it just took a massive drop off from 2021 to 2022 here. I mean, literally, they define an affordable home is where the person with their monthly mortgage payment is no more than 30% of their county's medium income. And we were at like 40 to 50% for the past decade, which isn't great, to be honest, folks. That's not great. Less than half or less can afford, but now we're at 21%, right? I mean, this thing's just getting bad. It's going from bad to worse fast. Now, on the rent side, here's a headline: U.S. households are now rent burdened for the first time ever. So if you're spending 30% or more of your income on rent, you're qualified as rent burden. They're saying that on the net now, U.S. households are net rent burdened. The three worst states right now are Massachusetts, Florida, and New York. But there's a ton of other states right behind them. It's and anybody that's been, living and having to afford their home costs, their housing costs over the past couple of years, knows what we're talking about here, right? It's just the cost of shelter has gone bananas. It's no surprise why it's the biggest chunk of CPI right now. And I just want to, I'll give my little personal anecdote on here. So Lance, you've told folks that you're renting. We are moving out of our place, and we're going to rent for the next year and a half while my daughter finishes high school. And rents in my area went ballistic during COVID, during the pandemic. A ton of people from the city, from San Francisco, came up here to either escape the city or buy a country home. Landlords, I think rents increased by like 50% in 2 years, and they're just not willing to bring those rents down yet, even though the demand really isn't there anymore. So, there's a total stalemate right now where you get a bunch of rental properties that are sitting there, just nobody, is willing to pay their the crazy rents that they're asking, and the landlords aren't willing to bring them down quite yet. So looking at the fact that I'm kind of on a timer myself, and I'm going to have to make a decision in the next couple of days of what place we're going to take. My options are basically between my rent increasing by 30% or by 50%. That's what I'm facing right now. And yes, I'm in expensive San Francisco Bay Area, but I think the percentages are relatively similar. My mother, we talked on this program a few months back. The residential living place she was in, a sprinkler broke during Christmas and she got flooded out. It's taking longer to repair where she was living. And so we're having to find, rentals for her. And again, it's the same deal. It's like prices are like 30 to 50% more than what they were even just a year or two ago at this stage. So I know a lot of people watching this are probably relating to what I'm saying, but it's the situation is bad in housing and it's getting worse is my underlying point here. And I just want to, you can react to anything I've said, Lance, but I just want to say this. I kicked this off by talking about interest rates back at 7%, right? That alone is supposed to have a mathematical impact on home prices that we haven't seen reflected yet truly in the markets. In addition to that, we've got these unaffordability issues that I've just talked about. We've got the increasingly pinched consumer, as their cost of living is rising, and real wages still remain negative. I don't know, we're in like the 24th straight month now of real wages decreasing. We have the potential for the coming earnings recession, right, that you and I just talked about, that oftentimes are accompanied by layoffs. And I'm going to mention the layoff data in just a second here. And then we have this sentiment shift, right, where we had Peter Atwater on this channel. He talks about the importance of sentiment in driving markets. And, my two questions for you, Lance, is like, how much further do we have to fall given that whole list that I just mentioned? And at some point, the consumer mindset shift is going to happen, like you were saying it was going to happen with, the expensive goods that we're all buying right now, right? Where they're going to say, wait a second, housing's not an asset anymore. It's becoming a freaking massive liability. And therefore, instead of stretching for more home, I'm going to switch my mindset and try to really shift to economy, where like I can get the cheapest square footage possible because housing's such a liability. Like when that kicks in, that could really open a trapdoor below housing prices. So anyways, I went on maybe more of a rant there than I intended to, but jump on in.
Well, no, I'll just say is like, you got, that may or may not happen, right? Look, here's what's going on with housing. And I'm in Houston, I told you this before, and just give you a good example. There was a house, and look, I told you before, my wife and I are looking for a house to buy, and we're being patient. We've got plenty of time because we're renting. But just a good example of what's going on still, there's still and again, we talked about this liquidity in the market. So there's two things going on. First of all, homeowners, if I'm a homeowner right now and my mortgage is at 3.5%, why would I sell my house? Because if I sell my house, great, I've got money, but now I've got to go buy a house and get a mortgage at 7%. So there's no incentive for me to move if I'm okay with my house. If I have to move, job, whatever.
Yeah, and just to add on to that, and because of the current situation right now where housing hasn't really come down that much in terms of pricing, it's a terrible trade, like you're saying, right? It's like, oh, I'm basically going to get the same house just for twice the expensive mortgage, right?
Exactly.
It makes no sense, right? It may make sense if prices come down to a certain level, right? That correction part hasn't happened yet.
Not right. And so just a good little anecdote, a house came listed yesterday, and my wife texts me immediately. She goes, oh, this is a beautiful house. It's perfect, right neighborhood I want to be in, etc. And before we could even get to our agent to schedule a showing, the house sold. Now, the house, after I went and did my research, the house flooded twice since 2016 and was $100,000 over market value for that neighborhood of the average square footage sold over the last 5 years. And it sold before it actually even made the full listing. And I'm assuming it sold at ask because they took the house off the market. So, again, first of all, remember that real estate is very location specific. And in this particular neighborhood, there's only 19 houses. So if one comes up, it sells immediately because people want to be in this neighborhood because of schools and everything else, but still willing to way overpay for that property. I'm not willing to do that. So, I told my wife, sorry, ain't going to happen. But, that's still going on the markets. And then the other side of this is that there is a very low supply of existing homes for sale in the markets because of the reason I just mentioned. Why sell your house if you don't have to and get a more expensive? You got to go somewhere. So unless you're going to sell and go rent and wait, but a lot of people aren't willing to do that. Fortunately, I didn't give my wife a choice. But, that's where we are. So again, this battle between buyers and sellers, it may last a lot longer than people think. I know there's a lot of people calling for this massive decline in housing prices, but there's an argument to be made that we may not actually see that. But to your point, Adam, and I absolutely agree with you, is that home prices, as of what we some zero rates, too much liquidity in the system, et cetera, we now have a massive deviation in home equity versus underlying incomes, which means that at some point this will buckle, but it may not be soon. It could be a lot later, maybe for entirely different reasons that we aren't even looking at right now.
It may be, and just like the markets, that just like the financial markets, we have to realize that the housing market may do different things than we think it should, right? And
Right.
I certainly have a history where it's done a lot of what I thought it shouldn't do over the past bunch of years, and it didn't care what I thought. I do think, for a lot of the reasons that we've mentioned on this program in the past, and the litany of ones that I mentioned a few minutes ago, I do think it's going to come down. But of course, that's just my opinion. It very well may take more than you think. But let me ask you this, Lance, because I've heard this put out there the other day, which is the country is now divided into two camps: those that bought homes under 3% and those who didn't.
Yep.
And I think I think it is true right now,
Yep.
right? If you did that, if you bought a home and you got a 3% mortgage, right, you're vastly better situation than somebody who hasn't yet and is struggling to afford shelter, as a renter, or they're looking to buy at these, higher mortgage rates, but the prices haven't come down yet, right? These folks are getting a raw deal. And of course, the lower strata of society is fully in that camp of the non-havers, right? This is a little bit like my question. You're going to take the over on the recession, but like it or not, is that just going to be the way of the game going forward, or do you think at some point the housing market is going to correct enough where there will be some more opportunity for equality there?
Well, so let me rephrase that a little bit. We have to stop fostering. And let me back that up. When I say we, I don't mean you, me.
I know.
We as a country,
as a society,
have to stop fostering these things. Let me give you a good example. So on Wednesday's radio show, we were talking about this article from the National Association of Realtors, and they came at that. What they said is there are times that making a low down payment on a house makes sense. And they gave you this whole litany of reasons why, paying, you can get an FHA mortgage for 3% down and those type of things. And, if you don't have enough cash flow to afford, a bigger down payment, then you can use a smaller down payment and still get into the house of your dreams, blah, blah, blah. Okay, well, first of all, the National Association of Realtors is the lobby arm and the marketing arm for realtors,
right,
which we have a record number of across the country right now. So they're trying to support their group, right?
And their conclusion is always, it's a good time to buy a house.
Exactly. No matter what's going on, always time to buy a house. But here's the thing about this. We would not have the housing problem that we have today if we went back to the financial sanity of owning a house that we had back when I bought my first home. When I bought my first home, first of all, the house, I could only qualify for so much of a loan based on my income, which that's still kind of relatively the same today. But to qualify for the mortgage, you had to have a 20% down payment.
Right.
Now, I brought this up and I got tons of emails like, well, that's not fair. People can't afford to save a 20% down payment today. Well, there's your first problem. If you can't afford to save a 20% down payment, you probably shouldn't own a house, because they went and surveyed all these millennials that we gave $1,500 checks to, and they all ran out and bought houses with their down payment that they just got from the government. And they were buying houses sight unseen,
right, no
inspection, neighborhoods that weren't, ideal neighborhoods, but it was just, there's a house available, I can afford it, boom, I'm going to buy it, right? And now they're full of regret. 86% of the people that bought houses now regret their home purchase because nobody told them about maintenance, upkeep, homeowners association dues, insurance, all the other expenses of breaking, fixing stuff that breaks, of buying appliances. Nobody told them about that.
Mold,
because in their apartment, this was all furnished for them. And when something broke, you just called the landlord and said, hey, my fridge is out, come fix it. And they would go fix it, right? And so now there's all these additional expenses. Well, if you couldn't afford to save up for the down payment for the house, you can't afford the payment on the house and all these other additional expenses. So now they're struggling, right? But this is part of what has fueled this massive rise in houses. And look, we didn't have this problem before. Houses grew about the rate of inflation until 2000. Beginning in 2000, there was a couple of little bumps here and there as we had little economic booms that, they grew a little bit faster than inflation. But on average, they were growing about the rate of inflation going back to 1900. But beginning in 2000, when Alan Greenspan said, oh, everybody should own a home, so let's do adjustable rate mortgages, that started it. And we started doing these funny things, right? Oh, avoid PMI. That's your mortgage purchase insurance, that if you didn't put 20% down on the house, you'd have to pay an extra insurance on the house to insure the mortgage, because, well, if you can't put 20% down the house, you might be a liability of paying that mortgage. So there was mortgage insurance if you couldn't put 20% down. Well, we got around that by doing an 80-20. We took out a loan for 80% and a loan for 20% to get around PMI. So this all fed into that accelerated. We figured out all these ways to skirt around that very basic financial rule that if you can't afford 20% down, you probably shouldn't own a home. And that's where we created, and then of course with subprime mortgages and blah, 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 blah. And that's what's created this repeated boom and bust in the housing market. We can't figure out why people can't afford a house, and this goes back to my statements earlier about, buying $1,000 phones and, $50,000 cars. You can stop all that, right? You have the power. Consumers have the power. They just have to go, enough. I'm going to say everybody's going to start going back to 20% down payments on a house. And guess what happens to housing prices?
Yeah, the problem is we're not going to do that willingly. There are two ways humans can learn, right? They can learn by insight, or they can learn through pain, right? They can sit down and look at what they're doing and think and say, okay, if I keep doing this, it's likely to have this outcome. If I want to avoid that, I should change my behavior today. We almost never do that, right? We just keep doing what we want to do until the pain of continuing to do what we want to do becomes more painful than the pain of switching. Right. And the classic example of this is the guy that doesn't change his diet until he has the first heart attack. Right.
And generally doesn't change after, but yeah.
Yeah. And it might not even change after. Yeah. And I mean, honestly, that's sort of what we had with housing, right? We kind of had our first heart attack with 2008, but did we change behavior? No, we just doubled down. Right. And one thing that you didn't mention that makes it even worse is the role of the Fed in buying up mortgage-backed securities. Right. They didn't own them before 2008, and now they own trillions. Right. Yeah. And so, look, if you can't make your loan payments, in the pre, global financial crisis world, well, you took the pain of having to default on your mortgage and, potentially have it get taken back by the bank, and the bank had to deal with a loan gone wrong and all the costs associated with that. Well, now the bank just sells the loan to the Fed and it's fine. Right. So,
but that's my whole point. You see, this is where we've gone terribly wrong, and we need to go back to the basics. Not we being you and me. I'm talking about the ubiquitous we of the financial system, the Fed, the government, everything else. Every time we have a financial crisis, the first response is to bail everything out, right? Oh, we can't have banks go bankrupt. That would be terrible. We can't have people lose their houses. That would be horrible. We can't have businesses go bankrupt. That would be terrible. No, it would be. But it also fixes the system, because you get rid of all these excesses and you get rid of all the bad players and the bad actors. So instead of changing the rules, stop bailing out the companies that are taking advantage of the rules. Because again, we bailed out Boeing in 2020 because they were on the verge of bankruptcy. It's like, oh my gosh, Boeing can't go bankrupt. Well, why were they going bankrupt? Because they spent 5 years spending all of their corporate profits doing share buybacks, right, rather than storing that money up for a rainy day when they would need it and get through a tough time in the economy, which always happens, right? Always have tough times. But again, the Fed is complicit. The government is complicit. We're complicit from the standpoint that we demand these bailouts. But it's not. But look, there's nothing. Look, you buy a house you can't afford. You file for bankruptcy, you start over, right? Nothing wrong with that. It's tough, it's painful. We learn from it, we move on. Same thing with companies. If JP Morgan went bankrupt, it would be bad for the financial system. But you know what would happen? All those accounts would get segregated out to banks all across the country, and you would have a much more stable financial system, because you wouldn't have 5 banks making up 60% of the financial banking system.
Dude, I'm right there with you. This is my whole point though, right? Which is that we are so far from being willing to make that decision yet, right? Even just on the populist side, right? So the corporations are never going to, they're not going to fight for not getting bailouts, right? I mean, they're just never going to do that, right? And the politicians aren't going to change because they're in the pockets of the corporations, right? But they're also not going to change because the populace, as you said, begs for bailouts, right? Like we beg, right now we're having an inflation problem. What do people ask for? And I understand it, right? Which is, well, give me money because my expenses have gone up. So come on, give us more stimulus, right? Which of course just feeds the inflationary fire, right? Because we're so short-term thinking. So that my point is the level of pain it is going to take for us to wake up and say, hey, we need to shift to an anti-bailout platform is going to be gargantuan. And I hope we don't have to face it, but I think we very well may have to.
Yeah. Well, let me rephrase that for you, because this is the key argument right here. What you're saying right now, and that what you just said is that is the key argument for capitalism. What we have right now is corporatism. All these bailouts, all these supports, all these things that we do that keep capitalism from working is corporatism. And that's why we're all running around going, capitalism sucks. No, capitalism is alive and well. If you allowed capitalism to work, companies would go bankrupt, people would lose homes, people would lose cars. That's capitalism at work. And that would fix your system long term, and you would have more equality in your economic environment and more equality within your households across the country if you allowed capitalism to work. But we don't. That's why we have corporatism, and that's the problem.
Well, and folks, I promise I'm getting to Lance's trades here in just a second. I haven't forgotten, and we'll wrap it up. But what's so unfortunate, Lance, and this is the evil of those that peddle the siren song of being able to avoid consequences, which is really what our leaders have been doing more and more over the past decades, right? By just kicking the can, right? Is now if you're trying to get the public's attention, right, and say, look, we have a choice to make. We can go to capitalism, true capitalism, right, which will solve our problems in the long term, but you got to take it in the short term, right? Like it's going to be great long term, but it's really going to hurt tomorrow, right? Whereas the other platform says, don't worry, vote for me, and I'm going to give you lots of free stuff right now, right? It's still so luring that folks are going to go with what appears to be so much more appealing in the short term, which you and I know is so much more destructive in the long run. But that is the choice, sadly, that offering capitalism right now, it gets compared against.
Right. And, I told you I'm going to run for president and nobody's going to vote for me. But no, you're exactly right. And look, here's the thing. And we can stop right here when I say this statement. If I was running a platform as president and you elected me tomorrow and I could make the speech, I would say, we are going back to pure capitalism. And we're going to do this over the next 4 years that I'm president. So everybody needs to pay attention and start putting on your big boy pants, because we're going to get to capitalism within 4 years. Now, as the president, I'm going to provide some supports financially over the next 4 years. As I start removing all of these other supports, there will be no more. If you're a corporation and you get in trouble, you will not get bailed out. If you're a bank and get in trouble, we will not bail you out. There is going to be no help on the horizon for you. You've got 4 years to get your house in order. Residents of the population, you've got 4 years to get your financial house in order. I'm going to help you for the next 4 years, but at the end of 4 years, we will be in a pure capitalist system. So be ready for it. And if you did that, you could work your way, everybody would start contracting, you'd have a recession, right? But you would start and then that's where you provide the support to allow that recession to occur, start moving everybody towards that. If people have to file bankruptcy, we get them through the system, get them bankrupted, get them moved out, those type of things, we help, right? We get them back on their feet, get going. But at the end of 4 years, it's all over with, and it stays that way. The other choice, to your point, is this. If we don't do that, at some point, the choices will be made for us, and it'll be made for us all at once in the most devastating of fashions. And that's what you're trying to avoid, but we just don't know that. We just haven't learned that lesson yet. But that's why you had a depression back in the 20s, and that's why you'll have another one at some point in the future.
What's that movie that's like winning the Oscars right now? Everywhere, everything, everywhere, all at once.
Oh,
something like that.
That's
Yeah, exactly. Well, look, Rance, I think you should run soon. Run on this next cycle, because I don't think you're going to get it.
Nobody will vote for me.
I don't think anyone's going to vote for you, but I wanted it out there so that when everything really starts to implode, people say, oh, wait a minute, there was that guy with the platform. Let's get him back, right? So exactly. All right. So as we wrap up here, Lance, trades for the week.
Only did a couple this week. First of all, we're continuing to shift our bond exposure to a little bit longer duration. So we had a lot of money in sitting in Bill, which is a 1 to 3 month Treasury ETF that its yield goes basically with the Fed. So it's yielding right around 4.5–5% right now. But we're starting to shift that into 1 to 3 year Treasuries, and then we'll eventually start shifting that 1 to 3 Treasury mix to 5 to 7 and 7 to 10, and so we're gradually kind of rolling those durations in the portfolio. So we're very close to a buying opportunity for TLT. We're not there yet, but we're getting very close now. Probably will occur in the next month or so. So we're just waiting for the right signal.
All right. And do you commit on this program to when you see it sharing with us here? So listeners
yes, one month after we buy, we will tell you here on this.
No.
No, yes, of course we'll share. And we also made 2 sales this week. We sold AMD and NVIDIA in our portfolio. Both those stocks have had huge runs. We were up like 50% in NVIDIA. So we sold that position, just took profits in it. And at some point, we're going to get a correction in the market, and I'll be able to buy those back a good bit cheaper. But we're still trying to reposition the portfolio right now, shifting between, as I was showing you earlier, between the value and the growth. And again, here, let me just share this kind of one final parting gift chart with you.
And as you do, can you speak to, given the fact that from the beginning of this discussion, we were talking about the technicals, and you said, hey, they're looking pretty good. Are you sort of adding risk to your portfolio right now?
That's what we've already did that. We kind of did that in advance. And so we're kind of well positioned right now for where we want to be. Again, we're not huge. We're not turning into huge bulls right now, but there's 2 things that are occurring. This is our sell signal, which is this MACD signal that we kind of follow. It's beginning to turn up. It has not turned back into a buy signal yet, but that improvement is very important here. When you typically get that buy signal, you typically get a decent move in the markets, and it's occurring at a fairly high level. So it'll mean whatever move we get won't be a huge one. But again, this is part of that move. We could get back to around 4,200, 4,300, which would kind of be the top of this, kind of 3 standard deviations from the 50-day moving average.
Yeah.
That's kind of these shaded band. But you'll see here, we came right off that 200-day moving average and ran right into the 20-day moving average today. So we've had this advance took us back above the 50. Now we're starting to run right back in that 20-day moving average. So again, this was a very bullish turn for the markets over the last couple of days. So again, we're in a good position. We're about 43% exposure. Our target exposure is 60. So we're still underweight equity exposure. But, again, we're kind of digging through, different ideas and different, sectors of the markets in particular, looking for those opportunities. And 2 of the areas that we continue to kind of focus on are these kind of oversold areas of the markets. Healthcare, utilities right now looking very attractive. Johnson & Johnson has gotten very oversold relative to its sector. It's also oversold relative to the market. So so if we do get that rotation from growth to value that we were talking about earlier on this next leg of the rally, we could see a real pickup in some of these companies like that.
All right. Well, look, I do want to remind folks again that the Wealthion online conference is coming up now. 3/18. What is today? The 3rd. So yeah, that's almost 2 weeks away. It's pretty much 2 weeks away from folks who are watching this on Saturday. So folks, do yourselves a favor. If you are interested in attending the conference, make sure you lock in the early bird price by registering now, because it expires on midnight on Sunday. We want to make sure if you come to the conference, you're getting the lowest price possible. To go register, just go to wealthion.com/conference. And as I mentioned, Lance, we've rounded out the faculty. It's an amazing faculty, but what made it even more amazing is we just got Mike Leibowitz, your colleague there, to come back on and give everybody an update on exactly what's going on in the bond market. And as you gave a brief nod to a few minutes ago, short-term U.S. Treasuries are now yielding 5%, right? And you and I talked a bit about last week about what a really kind of great opportunity this is now for a lot of investors, particularly those that are feeling a bit more defensive. And if they don't want to, try to get cute and try to play for this latest run, if they just want to be sort of just safe. And for really years, I've heard people say, man, if I could just get 4% of my money, that's all I need, right? Well, gosh, now you can with treasuries. It's a pretty great opportunity. So anyways, Michael's going to be diving into all of that. And we've got, who else? Just in case folks, you haven't heard me go through this before, we've got Lacey Hunt, former Fed economist, kicking it off. We've got Mark Faber. We've got Michael Pinto. We've got Stephanie Pomboy. We've got Danielle DiMartino Booth. We've got Doomberg. We've got talking about energy. We've got Nick Jurley talking about the housing market. We've got Mike Maloney talking about precious metals. We've got Craig Wishner talking about investing in farmland. We've got Lucky Lopez, who's going to go even further, more deeply into the car market and also tell you when he thinks the right best time to buy a car is, because he initially thought it was going to be Q2 of this year, but that is getting moved out now based upon a lot of what he's seeing going on. So it's going to be just a phenomenal gathering of minds, folks. And a reminder, if you can't watch live on Saturday, the 18th, don't worry. Everybody who registers is going to get replay videos of both all the presentations, but also all the live interactive Q&A that we have during the day. All right, well, just wrapping up here, it's Lance and I went through a whole bunch of a litany of reasons of why this continues just to be a tricky market and what looks to be a very concerning year from a macro perspective. If you'd like to get some help investing for that type of environment, work with a great financial advisor who understands all the issues we've talked about here. As I say often, if you've got a great one who already does that for you, great, stick with them. But if you don't, or if you want a second opinion from one who does, perhaps Lance and his team there at Real Investment Advice, just fill out the short form at wealthion.com to get a free consultation with these guys. It doesn't cost you anything, no commitment to work with them. They're just going to do everything they can to help you make a smarter decision today for whatever might happen tomorrow. Lance, I'll let you have the last word as we wrap things up here.
No, I mean, look, I think this rally is going to have a little bit more to go next week. But again, these rallies can be a little bit short-lived. So, don't chase. If you're not positioned for it right now, don't try to chase it because, again, we still got a lot of things to work through. We're not back into bull mode just yet, but we'll see.
All right. And with that, everybody else, thanks so much for watching. Have a great weekend.